got a good mix of folks from electrical contractors, we've got GCs, we've got facilities guys, educators. So we've got a good mix of folks in here. I'm Paul Cohen. I'm a partner with a regional insurance firm and insurance and bonding firm. We're in the consulting business. Work with a lot of different general contractors to sub-trades. On the board of Associated Builders and Contractors, and it's been neat to get to work with all different types of folks, different trades all over the country. Mostly what we do is in the Midwest. And today, what I want to kind of talk about is, everybody tighten up. Do you guys self-perform any work, or is it all paper? Just paper GC. Other folks that Mid-America, you guys self-perform your own work, carpentry, absolutely, trim mark, all that stuff. So what we're going to talk about is trying to get more of a concise number when you guys are estimating bidding projects of really pinning down all the different variances within the work comp, general liability, bonding. How many folks, just by a raise of hand, are required to provide bonds here or there? So almost all the contractors. So we'll talk about that, and I guess Jerry, I'll pick on you for a second. What are you doing right now when you're putting together a bid? Obviously, you've got all your labor costs, you've got materials, you've got all those different factors. What are you doing right now in the world of insurance and bonds? When you're putting together your bid?
Bonds depends on the project, whether they're required or not. Include that our bonding cost, or it's not fairly defined. We give an alternate for our bonding rate.
Okay.
Insurance-wise, we take that labor burden into our man-hour cost as part of our labor cost.
Okay. Cool. How about you guys? What are you doing for, as far as, when you're putting together a bid, how are you calculating work comp, some of these variable factors right now?
So if we don't have time to really get one from our insurance company, our bonding agent, and we're doing a rough calculation on bid day, and like I was saying, if it's not clearly stated, then we're going off some rough numbers. Most of our work comp stuff we typically know, but if we're needing just a rough bid bond on what it's going to be, we're doing some rough calculations. That's how we're kind of getting about that.
So more of estimating here by feel, not necessarily really pinning down the costs.
Exactly.
What do you guys do if you get a change order? Let's say your contract price is $500,000, and now we've got a $100,000 change order. Are you going back the same process of job costing for work comp and additional bond costs, those kind of things?
For us, I'm a subcontractor. I would say our work comp rates are worked into our billable rates for our install crews.
Okay.
And then we also have a fabrication shop, so that work comp is included, I guess, in our overhead numbers for fabrication numbers.
So more almost like a fixed.
Yeah, I would say we
and
revisit it annually after
sure.
Rates go up or that changes.
Right. And from Mid-America's standpoint, like let's say, what's the typical time frame of a project?
About 8 weeks.
Okay, so maybe a bad example. We'll talk about Titan, for example. Well, you guys are paper GC, so let's think of a job. Say I'm a contractor, ABC Construction, and I've got a job that I'm bidding today, but it's going to start in September, and then it's going to go for 12 months, 18 months. It's going to be a long project. I'm passing over a couple of different things. I'm moving from, I've got current work comp rates, I've got current general liability rates, I have an idea of what that is, I've got current bond rates, so I can figure all that stuff. But what happens, we're through, maybe that's 2 different policy periods for your work comp, and now we've got changes in experience mod. So maybe we've got claims that are coming in, our mod's going to jump up 10, 20%. And so how are we building those things in to that job that's going to go that time period? So what we're going to talk about today is kind of how to put more thought around when we're bidding with the work comp, so that these variable factors. So we've got builder's risk, property insurance, we've got all these different factors. We've got auto insurance, we've got tools coverage, we've got all these different insurance items. And those are more fixed. We know what they are. They don't change. In our two variable in the insurance world, we've got two variables: work comp that fluctuates with payroll. I think everyone in here understands that hopefully. And general liability, that fluctuates with payroll. So everyone has an audit at the end of the year. Insurance company, Travelers, or CNA, Hartford, whoever's going to come in, they're going to ask for all the payroll, the 941s, and then they're going to do an audit, up or down. So we estimate 100,000 in payroll, and they're going to come in and audit. And if we did $200,000 in payroll, we're going to have an additional premium to do. So those are variable factors, and so those are the variable factors that we're going to talk about, of building those into a bidding workbook to kind of give you an idea of what that looks like. Does everyone understand what, on the work comp side, what an experience mod is, what an experience modification is?
No.
Some guesses?
No.
Okay. So there's the National Council for the Commission for Insurance, NCCI. They issue an experience mod. So for Newman Brothers, they have their own specific experience. So when they started out and new in business, they started out at 1.0. And if they've got $100,000 in premium per se, then that's what they're going to pay at the end of the day. Now, after years go by and you start building some experience, based on your claims, it's purely based on your individual claims, that factor is going to either go down if you've got good experience, or it's going to go up if you've got bad experience, based on your claims. So you've got this shoulder injury, this slip and fall, and what that does is it follows you, and it's a rolling 3 years. So it's going to roll. You know, we move into 2018 now. It's going to be the 2014, 15, and 16 policies. So the most recent one's not going to be in there. 17 won't be in there yet. And then when we move into 2019, it's going to be 16, 17, and 18. Okay, so it's going to continue to evolve and follow. 1 year will fall off, and the new year will come on. And so that experience mod is in the policy. So what I want to show you is a sample declarations page of in a work comp policy, and that's what this is. So this is a sample of a work comp policy. You can see there in this so the CNA is the carrier. We've got, in this particular contractor's case, they do carpentry, they've got some office employees, and then they've got supervisors in the field, executive supervisors. And this is their experience model. Now they've had some bad claims. Okay, they've had some claims that now their mod is going the wrong direction. You know, all different types of factors: safety training, PPE, you know, hiring on the front end, agility testing, drug screening, MVRs, all these things that can play into why you're having work comp claims, right? So we start here. Got this. All this calculates through. Those are the base rates: 7.75, 0.17, 1.11. So what you get to is comes through all this. Get 19,000 in premium. This mod's cost him another 10 grand. Okay, 56% additional premium in that case. So that experience mod can add or subtract a lot of different costs. And then there's a lot of other factors that go on inside the work comp policy aside from the experience mod. And we're going to talk about some of these. So schedule credit, schedule modification adjustment. The insurance company, CNA in this instance, they can deviate from the base rate. They can either take 25% credit, or they can add 25% debit to the policy, purely based on their underwriting ability. The rates are all set with the state. They can't control the base rates. Okay, what they can control is their ability to adjust up or down based on the premium that they think that they need. And a lot of that goes into, you know, from the broker side, our negotiations with them. Hey, we need 5% additional schedule credit. We need 20% schedule credit, or whatever. You know, a lot of that is part of it. So in this case, they're giving them 11% schedule credit. So it's knocking off another $3,200. They're giving them, based on their premium, the CNA, they're giving them another 7.19% premium discount. Then we charge in some terrorism that you can't take out in work comp that's required, where you can exclude it in other policies. So where we started at $18,795 based on the base rate, after all these calculations, we're at $24,822. So if you're building your workbooks and you guys you're putting together bids, and we're just using base rates, well, you're going to be you're losing. You're going to have costs that are just floating around out there that aren't tied to the job. So work comp has a lot of different factors, a lot of different variables. The general liability, here's the general liability policy. And the general liability doesn't have these factors. General liability, the rate is the rate. But what we have to do is we have to take, in this case, you look at carpentry right here. That's that same carpentry code. We have to take the premises rate of $12.34 and the products and complete operations $19.93. We got to add them together. Okay, so that's one rate. We always have to add those two together. And so what we come to is we build this workbook. And what we've got here is, and this is just an Excel. I'm happy to share this with anybody after this. If you guys want to drop me off your card or show me your email or anything, I'd be happy to share it with you. So what I've done, this is just an example. This is a different contractor, different than the policy I just showed you. But what we first start with and what we need to enter on this worksheet is all the base rates. So all the base rates of that work comp policy. And then what we do is we've got all these different factors. And in this workbook, you can enter any one of these factors. You can change this experience mod and it'll adjust this modified rate. It's all built into the spreadsheet. Because all these different factors matter. In that one instance, we saw that their experience mod was a 1.56, so it was adding 56%. In this contractor's case, their experience mod is a 0.79, so they're getting a 21% discount off of what their premium typically would be. So these are all the different factors that go into this. So employer's liability increase limits. A lot of your guys' contracts, JPI for example, if you're doing work for Titan, their contract probably says, we don't want the base, just the statutory minimum limits. You've got to provide us for work comp and employer's liability 500,000, 500,000, 500,000 compared to 100,000, 100,000, 500,000. So that's the state minimum. So it costs 1.1% in this situation to add for that endorsement for your contract, for example. Experience mod 0.79, schedule credit. In this instance, the carrier was giving them 10% schedule credit. So that's that factor that can deviate up or down. The premium discount. In this situation, this carrier was providing a 13.14 discount, and then these terrorism things we can't change. So all these different factors. So then we come over here, and these are the factors. So if it's a 10% discount, we multiply these rates times 0.9. That's how it's taking it out. Same way. It's taking them all out. So in masonry, $8.14. All those factors go into it, and now their work comp, what we call modified rate for bidding purposes, is 5.18. Okay, so you're leaving maybe 30% on the table if you're using the base rate versus the modified rate, okay? So we want to make sure that those things, and so then what we do is, as you're putting together a plan, there's, maybe we've got $40,000, maybe we've got $40,000 of masonry on this job, and it's going to calculate it through $32,000 or $3,200. That's on the base rate. Then all these different factors go into it, and this is what our final work comp premium is for that specific job. On the same case, we took the general liability rate is in there as well. Took that premises and completed operations rate, we added them together, like I showed you on that policy, and that GL is in here too. So let's say we've got, we're going to do a little bit of carpentry. We've got a little bit of sheet metal as well. And so it's going to calculate all that through for our work comp in general liability premium. Any questions on kind of how that works? So KBS, for example, are you guys using something similar to get to what your job costs are for insurance purposes? Right?
Yeah, most of the time though, they're negotiated and we have a bond fee, a certain percentage, depending on how big the project is. So I think we've got like a $10 million school going, and a bond percentage would be 1%.
Okay. Okay.
So
I'll get into the bond piece in just a second.
basically when we would get, like, insurance is built into our bond. So if we
Okay.
would get like a change order, we run it through our profit and overhead percentage and add a bond fee on that.
The one thing that I would, about that I would maybe encourage you to look at and separate the two is, for bond costs, it's based on the contract, okay? For work comp and general liability purposes, it's based on payroll. So you've kind of got two different factors. So maybe in KBS's, you guys self-perform some things and sub other.
Oh, yeah.
Yeah. So let's say you've got a $10 million job and you're going to self-perform half of it. Well, in your case, if you're taking that $10 million and building in your insurance costs as a percentage of the contract, and you're subbing out a lot of that, then you've got some insurance costs that you're building in there that really are on the sub.
Right.
So that's why I would encourage you to separate out the work comp and GL out of that bond rate for that purposes. Those purposes. In Missouri, and I know you guys work in Iowa, other people, what other states do we have in here that folks would do work in? Kansas, Missouri, Iowa, any other states?
Nebraska a little bit.
Nebraska a little bit.
Yeah.
So in Missouri, and this is just an example from Missouri, there's what's called, and there's a handful of states have what's called a contractor's premium adjustment program. So Missouri implemented this many years ago to really for union contractors. So if a union contractor is doing, they've got a carpenter job, and for that hour that carpenter's working, I'm just picking a number, is being paid $35 an hour, and you've got a non-union guy getting paid $18 an hour. Well, there's the same, for work comp exposure, it's the same hour, right? And so what they've done is they've created this contractor's adjustment program that if you're paying over the average hourly wage in Missouri, I think it's for contractors is like $19.50, changes every year. If you're paying over that, they're giving you a credit. They're giving you a credit on your work comp policy, and that it applies in Nebraska, I believe Iowa, Missouri, and there's a handful of other states. I think there's 22 states or something that has that adjustment program. You fill out a worksheet and send that in. So in this case, This contractor has some union labor, and they're getting a 23.8% credit on their work comp from Missouri. So we translate that over to multiply the factors by 0.762, and you can see how those Missouri rates work in there as well. The other thing that's interesting about Missouri is they have what's called the second injury fund surcharge. It actually adds 6% to the rates. So that's a nuance with Missouri. So for that reason, that's why it's really important to split out by states and start building these spreadsheets. You know, if you've got Nebraska, if you've got Iowa, if you've got other states, because every state's going to be a little bit different. And make sure you're getting all those factors built in there. Any questions on that? So let's say we've got, in this case, the spreadsheet built the same way. So, you know, we've got payroll, we've got a little bit of demo we're going to do first, and then we've got, you know, sheet metal as well. So it just builds in, so you can continue to see what those costs are. So let's kind of switch gears. You know, if anybody has any other questions, to discuss kind of the surety bond side of things.
The workman compensation base rate and the modified rate, what are those values based on? Is that preset by the state, or is that your company?
The base rates?
Yeah.
What are they set on?
Yeah.
So every state sets their own what's called loss cost multipliers. It's a factor. And for every single class code, they've got their own loss cost multiplier in every single class code. So Kansas has, I can go on right now and show you Kansas. I could Google Kansas work comp loss cost multiplier, and we can see every single class code.
This was based off Missouri? Just curious.
Well, each so Kansas has their own, and Missouri has their own.
Okay.
That policy I showed you, that was a Kansas
Okay.
policy. But what happens is so then let's say the loss cost multiplier for carpentry in Kansas is 1.4. So then CNA, who has their base carpentry rate, let's say it's $5, they have to multiply that in Kansas times 1.4, and that's what gives them that, you know, 7.75, that rate I showed you on the work comp policy. That's where they get that. That's where they get that base rate. The 7.75, CNA has their rate, and then if it's in Kansas, then they multiply it times the loss cost multiplier to give you the base rate. But if you're not using all these different factors, you're not really taking all the things into consideration when you're job costing for work comp. Are you guys doing something similar to this for right now when you're bidding projects? Because a lot of times, you know, these factors and things that go on with, you know, the insurance world can be the difference of making or breaking the profit. And so, you know, if you're bidding a job and, you know, we've got I don't know, 10%, 20% profit built in there, just, you know, these can be the difference makers of making a profitable job or not. You know, we have this job, we finish it, we're like, oh, that worked out good, we made money. Well, now we have an audit down the road for work comp or general liability, and now we owe that $30,000 back for the additional premium there that we made over here. So it's really important to be building these in.
Is there a dollar amount you should be looking at to start building that in? But you're throwing some numbers up there that are probably nothing of these guys, but it's high for the line of work I'm in.
Clarify that.
I'm a subcontractor. My average proposals are or $20,000 or
Okay.
less, okay? Occasionally we have six figures, okay? You know, when I have my you know, whenever I win a project, I get a certificate of insurance from my insurance company. I do not mess with the spreadsheet you're working
So
with.
let's talk about that for a second. So you're talking, your average projects are, you said 20,000?
Yeah, just say 20.
Okay. And what type of work do you do?
Architectural products,
You're installing them?
provide, install.
And so the installation, what code are you guys classified under? Carpentry?
Yes,
Okay. So I'm going to use carpentry in Kansas, for example. I'm not sure if you work in
Okay.
Kansas or not.
both
What would be the payroll on that $20,000 job?
1,500, 2,000. No, just say three. Just say three.
So in this case, your work comp, the work comp and general liability is very, very minimal.
Yeah, very minimal. Yeah. So it's probably built into our.
If you're, I'm not sure what the carpentry rate is, but a lot of times that rate can be $15.
Well, it varies between a union installer and non-union installer.
I'm talking the base rate
Oh, okay, okay.
for work comp. So yeah,
So if I'm looking at projects over 100,000, maybe I should consider using this worksheet.
you know, I think, you know, if you get a gauge of what your costs are,
Mhm.
you know, for how much revenue are you guys doing approximately a year?
Our goal this year is like 2 million.
Okay, so, you know, your work comp payroll and premium isn't huge, but it's still, I mean, for a, you know, smaller growing company, it can be a big expense. So, especially if that carpentry code is one of the highest codes out there.
Okay.
Carpentry and roofing, I mean, that's where the claims are.
Okay.
So, right here, this policy has a $7 rate, base rate. Your rate could be $14, $15, $13, okay? So that would be double, triple that. So something to consider.
Okay.
You don't have to use it, but.
I was going to say, this is a good tool for just analyzing, so you don't get hit with the audit later on. If you are a subcontractor, I'm a subcontractor also, but I use something similar so that we can anticipate what our bills are going to be
Right.
later on, because like you say, you may,
If you've
Have those hours early on.
allocated it for a job, and you
Yeah.
know exactly what your profits are in that
Yeah.
job, the audit,
yeah.
you know what it is.
Yeah, we do.
If you're
Yeah.
not anticipating what the costs are,
Yeah.
because as payroll fluctuates, I've got a prospect that came to me, says, hey man, I need your help. It's got a policy that they put together that is based on $2 million in sales for the policy, for that general liability policy. Well, he's done $2 million in the first 4 months. So he's got this high rate based on the $2 million that is going to get audited out at, if he does $6, $7 million, that rate's not going to change. Your only chance to negotiate with the marketplace and get that rate down is up front, is now.
Yeah.
So let's say he's got a $25 rate on that $2 million for general liability. Well, if we knew he was going to do $7 million, well, we could get that rate down to, you know, $10 on the front side. And he's got payments throughout the year versus, hey, you owe us $70,000 and we need it next week at audit. So, so it's a real thing. It happens all the time. Is anticipating these things. But as long as you're cash flowing for it and accruing for it, then you should be good. On the bond side of things, how many folks in here know their bond rate? You're 2. 2.5. So another critical piece. Just like, you know, I may say, how many folks in here know what their experience mod is? How many folks would that be? You know, small handful. So building this spreadsheet, and I'll be happy to share this with anybody, but building this spreadsheet for work comp, we gotta know these factors, right? And so whether that's going to, you know, your accountant, your CPA, CFO, whoever that is in your company, of building this out, getting copies of the policies and just bringing that information over. If you've got copies of the policies, build a spreadsheet. So let's talk about the bond side. So we do quite a bit of surety bond work, and there's really two different ways that bonds are charged: on a flat rate or a sliding scale. So you said before, use a 1% bond rate. That could be a flat rate that you guys are estimating, or that may just be an anticipated rate. I'm not sure, but there's a lot of times where a flat rate of 1.5%. And this is just an example. 1.5% is the bond rate, and we just know exactly. We throw in the contract costs. We know exactly it's 1.5% of that job is our bond costs. There's other. Most contractors are on what's called a sliding scale. And to get more precise, it's important to build the exact scale that it is. So this is an example, and I would say of contractors doing more than I'd say $5 to $10 million in revenue. Folks that are doing more than that are probably on a sliding scale. A lot of times if you're doing below 5 million, below 3 million, you probably have a flat rate, okay? And so this sliding scale, this is an example of what's called a $25 sliding scale. And there's a bond manual, and it's set. As long as it's merchants or travelers or whoever the Liberty Mutual, whoever the bond carrier is, it's set just like those work comp rates are set with the state. The sliding scale is set with the state. You can't deviate from it. So this is the example of the sliding scale. The first $100,000 is 2.5%. The next 400,000 is 1.5%. The next 2 million is at 1%. The next 2.5 million is 0.75 of 1%. And so it scales from there. So knowing what that scale is, if you're on a sliding scale, and building into this workbook to know exactly what the bond costs are. So give me an example of a job that you guys were recently required to bond the size of the project.
Anyone?
Yeah.
The courthouse in Jefferson City, we don't see it, and that was like 3 years ago.
Okay, what was the size of that?
Our
contract
scope
cost?
was like 1.6 million.
Okay.
On the stone, it was this limestone scope,
Okay,
interior flooring.
sure. So let's, with 1.6 million, very similar rates. You're gonna, so if it's a flat 1.5%, you can see what that is. If it's on the sliding scale, you can see what that is. As the projects get bigger, and that's why I said most folks that are doing larger projects are on the sliding scale, is because it's to drive the premium down. It's something that you're trying to get more aggressive pricing as you're going higher. Now, some smaller contractors that are doing what's called these quickie programs, if you're not required to provide a lot of bonds, and you're on more of this fast track, or CNA has a fast track, merchants bonding does what's called their quickie program. It's a flat 3%. It's a flat 3%, and you know and it's for smaller jobs. So like $400,000 job, you know, is that's what you're talking about for those types of projects. So it's really important to be monitoring what you understand what you've got, what program you've got. You know, if you're doing the bidding and the estimating, and also is in this workbook for work comp and bond costs. Let's say you get a big change order. You know, are we coming back to this workbook to build that in, or are we just estimating here's the additional pay, here's the additional labor costs, here's the additional materials? Are we going through the same process, being diligent about that change order through this process? Like JPI, are you guys are hitting it to the T on those change orders, or are we going through the same process that you originally would be?
As they are, we basically have one trade, so our liability and everything's pretty consistent.
Sure.
And, put a bonding fee on top of any change order.
Okay. So let's think about bond costs in your bond rate, for example, for a second. What are some things that go into having a bond program? Think financial aspects. What are some things that go into to get that bond program? What do you need to do? Retained earnings. What are some costs and things that you've got to do externally? In some cases, you got to have an audit, CPA audit. Some if it's a smaller program, maybe you can get away with a review, CPA review. In Titan's example, you guys have to do an audit. Much different cost between a CPA review and an audit. What are some other costs that could go into having that working line of credit? Surety company wants to see that you've got a working line of credit established, $1 million, $2 million maybe, $500,000 line of credit in case things get tight and we need to draw on that. Surety company wants to see that you've got cash flow. Well, there's costs for all these things. There's costs for the CPA. There's costs for to have that line of credit to maintain that. Banks charging you fees. Are those things that you guys build into your bond rates? I have a lot of contractors that see all these different factors as part of their bond rates. Now, let's say Titan, you guys are on this sliding scale. You guys do a job for $25 million, and you guys probably have a philosophy that you require your subs to provide you bonds. Maybe if it's a contract over $100,000, over $250,000, you got to provide a bond. Project dependent, but a lot of times that can be the case. That you guys, your surety company, that gives them a better comfort level to make sure that the subs are bonded. So you guys may be doing a job for a GC that they're being required to bond, and then they're saying, hey, we've got to provide the bond, so I need a bond for you on this size project. They 1.1, well, it's for a city, so
Yeah.
municipality.
Yeah.
So I guess my question to you guys is, are you considering those other costs in the bond, in the bond rate? I have a lot of contractors that all these different factors that we just mentioned, they'll add another 1% to their bond rate. So they'll take this, build in another 1%, because I know that I've got $30,000 audit for a CPA or more. I've got at least $20,000 in interest expense to the bank to carry that line of credit. I know that if I am requiring a smaller sub that isn't used to bonding and they got to go get a bond, maybe they're on that quickie program that's 3%. They're building that into their deal.
So, a lot of times it's going to depend on what is allowed on the bond rate, how you get compensated for it. There may be rules in your contract that say what you can charge them for with that bond rate. And then the other thing you got to be mindful of is how are you proceeding with that bond rate.
Sure. So a lot of your stuff is private work. And with that private work, you're probably, like you said, perception. Here's our bond costs, those type of things. If I'm
But the flip side of that is that even if you're in public or whatever you're competing on, what do you think your competitors are? You're talking about covering all your costs, but is everybody really doing it?
So in the public, on public work, so let's say you're doing DOT, MoDOT, any type of, those types of work, city of Topeka, city of Overland Park, I mean, all those cities, municipalities requiring bonds. And if it's a public bid, it's more of that hard bid type world, and here's our price. They're not splitting out, they may not be splitting out every single detail as far as the bond costs are concerned. They just may have a line item in that proposal of insurance and bond costs, one lump sum. And so they're not splitting out, here's the exact bond rate. Where in the private sector, your owner, developer wants, they want to see that. Does that make sense? Okay. But yeah, I have a lot of folks that are, building in 0.5%, 1% for all these different things that are involved around having and maintaining a bond program. There's more that goes into it than just the costs that are going to the surety company. What questions you guys have about the bond side of things? So let's, I'd like to, are you guys required to provide a lot of bonds?
It's rare. I think in the 5 years I've been working there, I've maybe done it once,
Okay.
twice.
Okay. How about you guys? Is most of your stuff bonded?
Yeah.
Okay. So give us an example of a project that you guys that in the past that you guys bid on and won and performed. Give us just an idea of the payroll, and then give us an idea of the contract. Just pick a specific job, and we'll build this into the spreadsheet to see how that shakes out.
Okay. Let's, the contract amount, you want to start there? Yeah.
Sure.
3.875 million.
Okay. And are you guys bid with a flat bond rate, or do you guys have a sliding scale? Do you know that?
I don't know. I think we probably have a sliding scale. It's kind of worked into our program that we use.
Okay. So 3 point what?
3.875 million.
Okay. So let's go with this 25. This is a 2.5% sliding scale. Let's pretend that was the program that you guys were on. Okay. So there's our bond costs. It slides out. This formula takes it all into consideration, and then what you end up with is it's just taking this bond premium here and dividing by the contract price to get you an average bond rate. That's all that is. Now, if that's something that your owner wanted to see, and you have a sliding scale, that would be your average bond rate on a sliding scale. So then let's go over here. Was this a Missouri or Kansas job?
Missouri.
Okay. And do you know what your experience mod is?
I don't.
No feel at all?
I think that it's good. I think we've only had one work comp claim in like 10 years.
Okay.
And so I think it's.
So you probably got a credit mod. Let's just leave 0.79.
Yeah,
for
yeah,
that.
that.
Are you guys getting the Missouri contractors credit? Are you familiar with that?
I'm not.
Not sure if you're getting it.
No.
I think we are getting it because we use union scale guys.
Okay. So let's pretend that that's in there too. Okay. And any of these factors can change. Let's say, I'm just going to change this just for today, that you're getting an 18% credit on your, you get an 18% credit on your Missouri contractor's credit. So I'm going to change this factor to 0.82. Okay. And give me an idea of the class codes that you guys are working in.
The electrical,
Electrical?
yes.
Okay. So obviously this would be pre-filled with your trades, your class codes. Electrical rate, do you have an idea of what that base rate is? I would say it's probably $5, $4 or $5.
Yeah, ooh, $5.
Yeah, let's just go with $5. And what was the payroll?
I'm gonna, it was close to $1.25 million.
So, and I'm not sure what, let's just say that this was I'm not sure if you know the GL rate, but let's just say it was a $15 GL rate. Okay. So, your work comp costs were $34,000 for that job. The general liability costs are $18,000, $750 for that job, for a total variable insurance costs of $52,820. And our bond costs over here of $57,000. Did you have any change orders on that job?
Yeah, I don't know how much.
Okay.
Give me a sec.
Let's say there was another $1 million in change orders.
Yeah,
So that's your final bond cost. And let's say with that million was another 200,000 in labor. So there's your final work comp, GL, and bond costs. Is that helpful to get it more exact versus kind of this,
yeah, because my
Esti-
numbers are a little bit different than that. It's way more estimating, but I like the exact, your numbers look better.
What do you mean?
Like for instance, the bond, when the job was bid, I want to say that we put in there like $77,000, and it wasn't. I mean, because that says 65 or whatever.
Sure. And keep in mind that this is that's on a specific $25 sliding scale
Yeah,
rate that is very standard in the bond market.
yeah,
But you could be on something totally different, so that could be a factor.
yeah. No, I think that's.
But it's also is if you're on a sliding scale, but you're using a flat rate,
Yeah,
you're not going to come up with the exact number. So what this workbook does is pretty nicely is
Yeah.
builds that exact scale in there. So and this can all be adjusted based on what your scale is. So if you ask the bonding company or whoever at your business is in charge of that, maybe it's you, is understand with our insurance or bonding agent, I want to know what our bond rates is and what that's, if it's on a flat rate, that's pretty easy. But if it's on a sliding scale, I need to know the scale.
yeah,
And then you just adjust this workbook.
yeah. And we can get this from you?
Uh-huh.
Yeah.
Yep. It's the same way with insurance. So one thing to keep in mind is how long did that job take?
2 years?
2 years.
Yeah.
So here you got a lot of factors going on. Your experience mod for sure changed during that time period. I had unfortunately I had to deliver news to a client 2 weeks ago. Their mod's going up 40 points. They had a huge claim. They had a year coming out with no claims. They had a year coming in with 4 claims, and it was about $420,000 in claims coming in. Okay, it was 4 claims.
Yeah.
You get hurt more with the frequency than the severity. If it was 1 claim, not that big a deal because you've got the 16,000 of that claim is considered primary. The rest of it's excess. So if you've got 1 claim, not a big deal. But if you've got 4 claims and they're all hitting that 16,000, that's where it really dings you. So their mod's going up 40%. So if we're forecasting, and that's what we do as an agency, is help project for our clients, okay, here's what we can anticipate the mod to go to in 2019. We're already doing projections for clients. Hey, here's what that mod's gonna do in 2019. And if you got a 2-year project, and let's say his work comp premium, in this client's case, is going up 40% next year, and he's in the midst of a job that's 2 years long, well, he hasn't built that in anywhere.
Yeah.
But he's gonna get, those are job costs, 40% change in labor for work comp. That's a big number.
Does that go for all their projects that year, or is it just that
That'd go
one?
for all payroll for that policy period.
Yes.
So let's say that your effective dates, your policy dates are January to January. So January 1st, you start your new mod. So work that you guys bid six months ago is now, and then that's now in process. Let's say that in this case, January, is just now being affected by the new mod. Oh, positive or negative. But I guess what I'm encouraging you guys to all do is get more precise with those numbers, because it's available. It takes a little work, and you need to rely on your broker to forecast with you and those types of things, but it's all available. Because like I said, the experience mod is 3 rolling years, not counting the current year. So I can already forecast what's happening in 19 because I'm not concerned about the current year yet. The current year will be into 2020, but I'm not concerned about it now. I already know the past 3 years, not counting the current year, is what 2019 is going to be. So I can already tell you, hey, your mod's going down 10 points in 2019. Okay, cool. I'm going to keep my bid rates the same. That's just going to be gravy. But on the flip side, if it's going like my client up 40%, if he's not building that in somewhere, it's going to hurt.
Yeah.
What other questions on?
What's the terrorism?
So, terrorism coverage for property and general liability and like commercial umbrella, you could exclude that. It's a charge that I would say 98% of our clients exclude because it have to be, the government have to deem it a terrorist attack, which I'm not sure that they would ever do that. It hasn't happened since 9/11, which is when that whole terrorism thing started in insurance. And it would have to be over $100 million in total damages. So in work comp, you can't exclude it. So if it's something terrorism, work comp's going to cover it, and they're already charging for it. Yeah.
Going back, you said on that 40%, you said you can project out years ahead. So are you looking at the whole, all the just say electrical or contractors around the nation or in that state that to get that number? I mean, because if he had 0 for the 3 years before and then he get to 4 just all of a sudden, how do you get that number ahead?
Well, you're not looking at all contractors across the country. You're looking specifically at
Well, that's what I
yours.
mean. This was the state.
Just for you guys.
Mhm.
Just looking just for Mid-America, looking just for you guys on what's happening in your claims history.
So if we had 0 for the previous years,
Yep.
and then you're saying you can project out though.
So if you've got, so I'll give you an example. I've got a client, a very large client, their experience mod is 0.34. I've got other clients that the lowest point that they could go based on their size, payroll and premium dollars, could be 0.85. That's the lowest point that they could go with 0 claims. So everybody's a little bit different based on their payroll and premium size. So, yeah, if you've got 3 years of 0 claims and you're getting a credit mod, like what's your experience mod right now? You have an idea?
No.
Okay. then, and you've got claims that are now coming into, let's say you had a claim last year, and now it's gonna roll on to the experience model worksheet, it's gonna affect it pretty substantially.
So would you say gradually, if you're having several years in a row, no claims, do you want to do like a gradual increase just to cover you in case something does happen that you didn't project for, or?
Yeah, that's,
So, I like using more real numbers. So if we know what the experience mod is, we use what's called, it's a software called ModMaster. And a lot of agents have access to ModMaster. It's a software that you plug in the data. Hey, here's the claims that have happened. Here's all the dates. Here's the effective date. And it can forecast. Forecasts, hey, here's what the mod's going to be January 1st of 2019. Those are all things that you got to kind of use some tools to get you there. But I guess what I'm trying to show you here is a way to use more exact numbers that are available to you versus just kind of estimating. What other questions do folks have? Are you guys using something similar, or how are you guys job costing right now as far as insurance and bonds?
As far as bonds go, we're on like the CNA fast track deals. It's just a flat rate.
Uh-huh.
We don't bond a lot.
Okay.
In insurance, we what it costs for a year, we kind of divide that back into our hourly rates. So it's not.
It's not exact by any means, but yeah.
No, it's not rocket science by any means.
So I would encourage you to lean on your broker a little bit. You know, within all these premiums, there's commission dollars being paid. I'd rely on them to, hey, I want modified rates. I want you to modify the rates for me based on all of our different factors. So that's what, that's part of our job is to help you be successful. So
I guess I have a question about EMR for the mod rating.
yeah.
Our rate has been the same like forever. We haven't had an accident in 10 or 15 years.
Good for you.
I know, we're lucky.
That's awesome.
What do you do to get that down? Is
Further?
there any way to get it
How do you get that
further
down
down?
further? So like I was saying,
Is it based on man hours worked, or?
So if you're in carpentry and he's in electrical, those are two different codes. So you've got 5403 and 5320. Okay, so two different codes, two different base rates, and with those codes comes expected losses. So that's that experience mod. If the calculation is we've got 100,000 in payroll and we've got this amount of expected losses, if we have this amount of losses, that's where you get your credit mod. That's where you get the 0.79, 0.8. In the same sense, if here's our expected losses and we have this many claims, that's where you get that 1.56, where I showed you that additional premium. They're going to charge you a surcharge. When you have 0 claims for the rolling 3 years, you're at the bottom as far as down as you could go. What I mentioned to you earlier was a client of mine that they have $1 million self-insured retention. So on every claim, if it's below $1 million, they're paying for it themselves.
So that doesn't go against them?
So it doesn't go in their mod.
Okay.
So they're a big company keeping everything underlying out of their mod. So in their worksheet, here's this huge company that has 0 claims for 3 rolling years, but their mod's a 0.34. So the insurance companies actually have a difficult time charging what they can. They charge $1 million for premium, they end up with $340,000 after that credit,
Right.
And they're like, I can't write that for $340,000. But anyway, that's a whole nother topic. But that 0.34 could be totally different from you guys. The lowest mod that you could go, maybe it's 0.93, and that's okay too. But for marketing purposes, let's say you're putting together a bid or a pre-qual form. You're doing a bid pre-qual and all these different things. What's your mod? 0.93. And this other electrical contractor over here puts together their pre-qual form and they're at 0.68. Well, on the cover, you're like, oh, well, they're safer, right? No, that's not necessarily true. And so what I encourage folks to do is if they are, maybe they're just not of that size, attach that experience model worksheet so you can see, yeah, you guys have 0 claims. They may have claims, even at a 0.68, but because of their sheer size, they're able to drive that down. Does that make sense? I mean, sometimes use that to 0 claims for 3 years, and it's been that way for a long time. You guys should be marketing that. You guys should be selling that, and not just putting what our number is.
Right. A lot of these prequels you do them online and also give you a box to type in your 0.82 or whatever.
But you can always add attachments.
So, just, does that help a little bit? I mean,
It does.
everybody's mod's a little bit different.
You mentioned the client that had a reserve for work comp claims. You're saying they're not, I guess, submitting those to the insurance company, they're just paying them off?
Yeah,
Is that what you're saying? Okay.
they've got $1 million deductible for
Okay.
them. And just for,
Okay, so they may not
They
turn
keep it
that
all
for you.
off.
Okay.
well, they turn them in, but then we have what's called we have a TPA, third-party administrator, that's managing all the claims.
Yeah.
And then whatever, let's say the claim gets settled out at 270 grand, they bill them for it,
Yeah.
and then they pay it.
Yeah.
It keeps it out of this mod.
Yeah.
So, it's a strategy that the larger businesses are using to keep the claims out of there. But it's also a strategy that maybe a smaller scale that you could implement, which is a smaller deductible. So let's say you want to take on a $5,000 deductible, $10,000 deductible for work comp. It's going to keep all those small claims out of your experience worksheet. Anything under 10, you still turn it in, it still gets repriced based on that carrier's negotiation and all that stuff. And then they bill you, hey, it was $7 grand, here's the bill. It stays out of the worksheet.
Yeah.
So it's a strategy, and the carrier will give you credit for that. Maybe they'll give you 5% credit on the premium for taking on that deductible. Some carriers, Missouri Employers Mutual and MEM,
Yeah, that's what we have now.
that's what you have now,
Yeah.
they won't do it.
Yeah. No, we had a couple of claims in 1 year, and so we were with Travelers, our lock-ins are broker, and
Uh-huh.
Travelers dropped us, so we went to MEN, and,
Yeah, MEM, and every carrier is a little different. MEM doesn't like, they will not do a deductible because they feel like they lose control. Okay, you got a $5,000 deductible, now you're gonna try to manage that claim yourself versus us investigating it and doing everything in the front end. So every carrier is a little different, but they're one that
yeah.
won't allow that.
So you're fine, when you do that adjustment, or kind of determine you want to take it on, I guess, any future medical claims or anything like that, I guess you're on the hook for those also, you're kind of closing it out as a work comp claim and saying,
No, it's still, I still encourage
Still-
anybody that's on that deductible, you
Yeah.
still process like work comp.
yeah.
Here's my first report of injury form.
Yeah.
Here's my claim investigation, all that stuff. Submit to the carrier.
Yeah.
Get that adjuster's involved.
Yeah,
They just end up sending you the bill.
okay. Once it's
Whatever,
settled,
when
yeah.
it's done.
Yeah.
Because worst thing you want to do is handle the claim yourself. Oh, here's $4 grand. Oh, now this thing got infected, and now I need PT, and now you're way behind the eight ball. So. What other questions they may have? I know I'm kind of standing in the way of Jack Stack Barbecue.
No, you're not.
Builder's risk, we've kind of created another worksheet for that. There's a couple different forms of builder's risk. So there's some policies that, and I'm not sure how yours is set up, but there's some policies that are on monthly reporting, that we report every month. Here's the projects that are ongoing, contract, cost to complete, kind of a whip schedule basically. And you report monthly. There's other policies that are just blanket. You got $25 million of builder's risk covered, and we pay $50,000 a year, but I'm just picking numbers. And others that are just for that job. So here's this job, and I just have my own policy specific to that job. So on estimating for, let's say you're on a monthly reporting, there's a specific rate for frame, there's a specific rate for masonry, there's a specific rate for metal, steel, non-combustible, all those different things, joist and masonry. So I would build a similar workbook and know exactly what those bond rates are if you're on kind of that more blanket type basis or a monthly reporting. Job specific can be tough because one of the reasons why we may have you on a job specific is because each developer owner has their own specific requirements. So, I'm doing this job for a block and they want this for soft cost, they want this for delayed opening, they want this for earthquake and flood, and so in your case, we may need to specify each policy to each job versus putting it on more of a blanket basis. So that makes it a little tougher. But for general, estimating, you should be able to get, frame rates, non-combustible steel, all those different rates for you to build it in. So, I don't know if that really answered your question, but